Well, it was an interesting day in the market today. Normally you have all indices kind of tracking one another up or down. Today we did see some divergences. We saw the Dow Jones do very well, up nearly 0.7%, which is a very good day for it. On the other hand, the S&P 500, after being up earlier in the day, actually finished flat, and the Russell 2000 and the NASDAQ both closed lower on the session. One of the big stories of the day was that interest rates, so close to 3% on the 10-year, didn't quite get there, actually pulled back today, and then that had some effect on some of our interest rate sensitive sectors out there, which is where I want to focus our trade application example for the day. So let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It is February 22nd, 2018. Want to welcome everybody on board, whether this is your first time watching or whether you're a longtime viewer of David and I's videos. Remember, if you're not already subscribed to our channel, we'd encourage you to do so by clicking that red button there on YouTube. In addition to that, if you enjoy these videos and you want to see us continue to do them going forward, make sure you click that thumbs up as well. It's a real quick way to let us know that you appreciate these videos and you want to continue to see them in the future. In addition to that, you can also scroll down below, take a look at the comments area, and ask questions or leave comments about these videos, and we'll do our best to get back to you, either responding to you in the comments area itself or in a follow-up video. In addition to that, we have a description area that includes a link that you can sign up to receive notifications whenever we do post these videos, as well as letting you know which stocks have been on the oversold and overbought cluster list within the S&P 500. Now, in addition to YouTube, we're also heavy users of Twitter. Make sure you're following us on Twitter. My handle is @BrandonVanZee, all one word. The Market Scholars Twitter handle is @market_scholars, and make sure you're following David as well at DavidSettle42. If you enjoyed these Market Outlook videos, be sure to like and retweet those videos each and every day on Twitter. Did notice here we haven't been able to get up and over 100 here in the last couple of days, so hopefully that's not a reflection on our abilities within these videos. Again, that's what we use to judge whether we're making a positive impact on you guys or not. So make sure that you're out there, taking care of business on your end. Just takes a quick second or two to go over to Twitter, click the heart sign and the retweet button there. All right, in addition to Twitter, we're also on Facebook. We'd invite you to join us within our group there on Facebook. It's now about 900 strong. I think you'll enjoy having some other folks that are interested in the markets around you in their cozy little group there. All right, let's go ahead and get started with some analysis on the market. As you can see, I've got the S&P 500 pulled up in front of us here, and as I mentioned in the intro, we were flat on the S&P 500. Now, where do we stand with the posture from the market forecast perspective? Down below, you can see I've got the market forecast indicator pulled up, which of course consists of our intermediate term green line, our near term blue line, and our red momentum line. And you will notice that the green line, which is what you're going to want to focus on if you're looking at an intermediate time period, let's say 3 weeks to 3 months. If that's kind of your typical trading period, then that green line is going to be the one that you want to focus on for your posture development to determine, are you bullish, are you bearish in this market? Right now, slightly bullish. It's not very adamantly bullish at this point. It's more of a sideways moving green line at this point, as you can see down below, but it does kind of give us the green light to take bullish trades if we so desire. Now, as I mentioned a couple of days ago, and I think David mentioned in the video last night, we also have to be respectful towards price. Remember that price is clicking up against that 30-day moving average and having a really hard time getting up and through there. It went right up there on the 16th of February and then has pulled back since then. So I'd really love to see us retake that line. In fact, you can see that the 30-day moving average on the S&P 500, that line right there is now colored red, and what that tells us is that price is below a falling moving average. So would really love to see some action above that line here. We'll see if we can stabilize in these ranges as we speak. Let's take a look at the 4 grid now, because that's what is somewhat interesting here today that I mentioned in the intro. Usually we see markets kind of all go up or down together. Today we didn't really see that. Notice in the upper right, we've got the Dow Jones Industrial Average. It was up 0.66% today. If you look at the S&P 500, it was only up 0.1%. Down below, we have that NASDAQ that was down 0.11%. And then we have the Russell 2000 small caps in the lower right, and that was down 0.12%. So kind of a mixed bag out there depending on which market you happen to focus on as an investor or as a trader. If you're somebody that's into the small caps or high tech arena, you probably struggled on a relative basis compared to those maybe more income oriented investors that did see a little bit more of a positive outperformance today because interest rates did pull back. Just out of pure curiosity, I am wondering what led the Dow Jones higher. I haven't looked at this myself yet, so let's explore that together. Remember, the Dow Jones is only 30 stocks. It is by far and away the smallest of these four indexes from a components perspective, so it's a little bit easier to hone in on who are the big leaders or laggards within the Dow Jones. Let's go over here to our Market Watch tab on Thinkorswim. I'm going to come over here to the quotes area, and then I'm going to pull up a public watch list on the Dow Jones Industrial Average like so. And you will notice that on the upside, we did have United Technology, that was up 3.3%. We had Caterpillar, that was up 2.3%. And we had 3M, that was up 1.6%. On the downside, you did have Cisco, so maybe not a surprise there. As I mentioned before, NASDAQ was down today. Remember, there's a lot of crossover securities like a Cisco that's going to be in the S&P 500, it's going to be in the Dow Jones, and it's going to be in the NASDAQ. But you can see Cisco as maybe a barometer of what's happening with technology, down 0.79% here today. Let's get back on track with some of those charts. Let's go over here to our three green arrows view here. Now, the other thing I should mention before we switch over to the charts, notice that all of the background colors of those four indices remain green, and therefore we do have a bullish posture using the market forecast technical indicator on all four of them, despite the fact that a couple of them did fell on a one-day only basis. All right, let's take a look at our next chart setup here. This is going to be our three green arrows chart setup, and we don't have an opportunity to show our three green arrows here today because none of the indices actually have three green arrows. Now, that's maybe somewhat negative, but on the positive side of the equation, at least if you're bullish, we don't have three red arrows either. When we have this particular view here, you're noticing that we have white background charts. What that's telling me is that of the three different indicators that we like to look at to determine strength of trend, we've got a mixed bag. There's going to be either two green arrows and one red arrow, or two red arrows and one green arrow. So let's examine a little bit further. Sometimes a picture is worth 1,000 words. As you can see, with the S&P 500, we got this red arrow on the 30-day moving average when we close below that 30-day moving average way back on Groundhog's Day, February 2nd. So that's one red arrow for the S&P 500. We have a green arrow with the MACD. Remember, we use that to judge momentum. So we do have some decent momentum coming off of some of those lows a couple of weeks ago, but truthfully, we have stalled out with that as well. It's good to see us above the zero line, retaining that green arrow, but you'll notice that the bars themselves, the height of those bars has kind of stalled out there. Those of you that used to attend my top-down trend trading class know that we really like to see those bars continue to ratchet higher. In fact, one feature of these charts I should point out, let me kind of zoom in by right-clicking and going into Maximize Sell. Notice that on the MACD itself, on my chart setup, when you see these bars go from green like we have right here to gray like we have right here, it means that that momentum is starting to fade. It's not aggressive yet, and that's why we don't have a red arrow on it. It hasn't crossed the zero line, but it's just starting to stall out. So it's something that we want to monitor. Now, as a reminder, I get, seems like, emails every single day after I do the Market Outlook video. Hey, how do we get your chart set up? I'll remind you one other time here. Hopefully everybody's listening. I do understand that the resources that I used to have available with my old employer no longer available, unfortunately. That's the way that goes. The good news is I am planning on doing another tutorial video and showing you guys how to set up these charts, and we're going to make those available for all Market Scholars clients once David and I launch our subscription services, and hopefully that's going to happen here within the next couple of months. So thanks for your patience along the way. We'll get these charts to you as we'll be using these in our trading rooms. David and I will be using these types of chart setups for making decisions within the portfolios that we'll be managing when we start up our trading rooms. So for those of you that are planning on being Market Scholars clients, we're going to get you all of these charts that you'll see here during the videos that David and I do. All right, so the point is, right here, we've got a mixed bag across the board with the 4 different indices. When it comes to the 3 green arrows setup, we've got kind of white background charts, which is more of a neutral feel to it. If we take a quick look at our next chart setup, this is going to be our longer term charts. The other charts that I've looked at so far have been 3-month daily candle charts. This is a 3-year weekly candle chart, and it's meant to be kind of a good barometer for long-term strength of trend. And it's something that if you don't have the ability to be very active with your money, but you still don't want to be a buy and hold investor, you want to be somewhat active, let's say with your mutual funds and your 401ks at work. Of course, that's not a recommendation. We don't give you those since we're not your licensed financial advisor or broker dealer, but you can see how that would have been a very acceptable way to be trading the markets in the last few years. People would have gotten bullish across the board with these 4 different indices in early 2016 and continue to be bullish right now. Now, of course, you know, a couple weeks ago, we had a 10% pullback from the highs, and for some of you, that didn't feel very good. So remember that in order to take advantage of this type of a setup, you have to be willing to withstand the pressures of a 10% pullback along the way as well. So it's not right for everybody, but for those of you that enjoy kind of having your money with the trend and understanding you're not going to get in at the bottom or out at the top, it can be an effective way to look at the markets. And right now, we do have bullish long-term postures across the board with this 10-40 weekly crossover method that we use here. Moving on now to our sectors 12 grid. And remember, on the sectors 12 grid, I do have to turn off that camera feed so that way you guys can see each and every one of those 12 charts there in front of you. So let's take a peek at what's going on here. Now remember that the way I've coded these charts using ThinkScript is when we have a bullish posture using the market forecast tool, intermediate term line, then the chart backgrounds will be green. When we have a bearish intermediate term posture using the market forecast, then the chart's background will be pink. And so you can see we've got a little bit of a mixed bag right now. We do have the S&P 500 in our upper left, and all of the 11 charts after it are the 11 sectors within the S&P 500. And so as you can see, S&P 500, bullish posture right now. If you want to take bullish trades on the S&P 500, you have a green light to do so according to the market forecast indicator. Some of the areas that caught my eye as far as being different than what we've seen recently has been in regards to interest rate sensitivity. First of all, take a look at what's going on with financials. Interesting. Financials right here, kind of in the middle to the right, we have the financials down 0.83% today. It's one of the worst performers on the day. Notice we now have a pink background chart. Interesting, because financials had been one of the leading sectors up until just the last 24 hours or so. And if you look directly below the financials, you'll see real estate. Now, these are mostly real estate investment trusts. Many of you are aware that they are kind of bond-like alternatives or bond proxies, however you want to say that. They're generally higher than average yielding entities that kind of compete with bonds for investor money. And so when you see interest rates spiking, like we've seen here recently, you typically find that real estate investment trusts struggle mightily in that type of environment. Now, this is something that a lot of us have been waiting for quite some time. I mean, after all, interest rates have been in a downward spiral since the early 1980s. It's only within the last, let's call it year and a half or so, maybe 2 years, where there's been a legitimate thought that interest rates might have actually bottomed. And if we are now about to go into some sort of upward trending interest rate cycle for the next several years, it would be my expectation that real estate investment trusts and utilities will struggle on a relative basis. They might still be up after accounting for all the income, but they might have some headwinds that they have to deal with from a macro perspective because of that interest rate sensitivity. So keep that in the back of your mind as you're positioning your portfolios. you know, a little bit later today when I show the trade example, I am going to show you a bullish trade opportunity within the real estate space from a shorter term perspective. But if you are somebody that believes that the 10-year interest rate environment is going to go from approximately 3% to approximately 6% in the next 3 or 4 years, then you're probably not going to want to overload your portfolio with a bunch of REITs and utilities. So that really caught my eye because we're starting to see maybe a transition. Now we got to be careful here too, because we have head fakes with the market forecast indicator, just like you have head fakes with any technical indicator out there. Nothing is 100% when it comes to technical analysis. But this is one sign, maybe an early sign, that there's about ready for a change out there. Sometimes, you know, you can kind of get the sense that everybody's on one end of the spectrum. In fact, I'm just as guilty as anybody. You know, if we come over here and we take a look at my Twitter feed, let's take a quick look at one of the things that I posted here just yesterday. Right here, I said 10-year treasury yield so close to 3% you can smell it. Now, at the time when I posted that, interest rates were at 2.95%. So if it was me and all the other investors out there that thought 3% was a sure deal, then what's the market going to do? It's going to do its best to aggravate the heck out of all of the market participants out there. So who knows? Maybe this was one of those head fake moments where everybody assumed that crossing that 3% line was inevitable, and the market has a different point of view. Maybe the market makers are on the other side of the trade because too many market participants are assuming interest rates will go through 3%. Maybe this is the time for a little bit of a reversion to the mean. So we want to keep our eye on that particular story. Since we're talking about the sectors right here, let's go back over to our Market Watch tab and let's just pull up the sectors briefly just to highlight the fact that we have XLRE. You know, when I actually looked at this before this recording, and I started pretty early here today, immediately after the market stopped, we actually had XLRE as the best performer, but right now it's showing that XLE, energy, just went up just barely more than that. So be aware. Now that's on a mark percentage change as well. Maybe I should try just to give you guys an idea too, because I know sometimes we have new folks that aren't as familiar with the Thinkorswim platform that like to pick up a few tips and tricks along the way here as well. If you ever want to add a column, what you can do is look over here. There's this little gear icon way off to the right. If I click on that gear icon, I can then go to Customize. Once I'm in Customize, I can then start selecting items from the available items on the left of this pop-up here. And our current set is how I currently have things set up. And so as you can see, I have mark percentage change right here. Now, mark percentage change will change in the after hours sessions. So we got to be careful with that. Percentage change does not. So I'm going to put percentage change right next to the mark percentage change. Now you'll notice I just drug it over there. You can also click on it here and then click add item if you want and then move it up or down over here. Whatever suits your fancy there. But I'm going to go ahead and click on OK. Once I've done that, let's see if that changes things. And indeed, it does. Good. I didn't want to be made out to be a liar here. You can see that if we use just percentage change as of market close and not anything that's happening after hours, that XLRE, if I now sort by percentage change, click on it twice to get the best at the top, you can see XLRE just barely nudged out energy. So real estate was up 1.14% today. That was a big move higher. Notice on the bottom side, or very close to the bottom, was the financials, 0.83. So again, that relationship seems to hold true as long as we make the assumption that interest rates were falling somewhat today. And we'll see here in just a moment when we get back to our 12 grid that indeed that was the case. So point that I want to make here right now is real estate, bottom right hand corner, after getting beat up time and time and time again for the last several months, right now has a bullish posture using the market forecast intermediate line. If I right click on that and go to maximize sell, you can see that that green line is pointing up just barely down below. And if you need to read it a little bit closer, notice these labels that I have on here as well. Intermediate term 32.43 and rising, and therefore we would consider that bullish. Now, some of you are going to look at this and say, there's no way I'm taking a trade on that because I respect trend too much. And I wouldn't battle you on that. You know, obviously this is not for the faint of heart, but for those of you that like to go out and look for value-oriented opportunities, we now have a technical reason, aka the green line pointing up on the market forecast tool, and maybe a value orientation because prices are much lower today in real estate than they were 3 months ago. All right, let's go ahead and move on to our next 12 grid here. This will be our foreign markets 12 grid. And we've got a bit of a mixed bag here, as we did on Tuesday when I last did this video. You'll notice here that some of those same areas that I pointed out on Tuesday continue to be reasonably strong. The two that I want to point out are the top two, Brazil and Russia, looking pretty strong here. The one that I did point out as well as on Tuesday as being somewhat bullish, but cautionary bullish, because I said there was that double top that was potentially forming. South Africa does remain bullish from a posture perspective, but you'll notice a lot of these candles lately in South Africa have these long wicks at the top, telling us that while the bulls wanted to push that market higher on an intraday basis, the bears took back some of that steam by the end of the session. So as you can see here, we have Brazil, we have Russia, and we have China from our BRIC countries up at top from an emerging market perspective doing reasonably well with bullish postures. Let's now take a peek at what's going on with the intermarket analysis 12 grid, and you can see here that the one that I wanted to point out is the second one from the top, which is the TNX. Now this is a good way, our benchmark security, so to speak, on how to look at interest rates in the United States. This is your 10-year US Treasury yield. And you can see that we had a 0.88% pullback here today. It's been fairly rare to find those pullback days. As you can see, this is not a broken trend. So again, we got to be careful here. One day does not make a trend, and so we have to respect that. But at the same time, we're starting to see some of that bullishness out of either your utilities and real estate companies where maybe they're sending a signal ahead of time before interest rates know they're about ready to top out for a little bit. You know, I think a lot of people believe that we're now in this new upward move with interest rates, and so we have to remember that just like stocks or bonds, interest rates don't go straight up, and so we might be time for a little bit of a pullback after a really healthy move to start the year. We'll have to keep our eye on that, which does then bring us to our trade application example here for the day. So I'm going to come back over here to just a regular market forecast chart. Actually, you know what? I'm going to do this first to set this up. I'm going to come over here to a dividend stair-step chart that I use regularly in my dividend classes and that I will continue to use once David and I launch our classes as well. And I wanted to point out that public storage, this is ticker symbol PSA, has really been beat up lately, like a lot of REITs. You'll notice that its price action is way down below here after topping out at $277 just a couple of years ago. It's now trading below $200 here, well below a lot of those yield levels that many of you like to seek out, meaning that Public Storage is a company that has been beat up enough where it now might be viewed as an attractive yield candidate. Now, if you didn't catch it over there, it was yielding 4%, and you can see that over here as well. Its current yield is 4.14%. A lot of times you find PSA over history trades closer to a 3% dividend yield, but price is inverse to yield, as many of you are aware, and so when price goes down in a security, its yield goes up. So is that an opportunity? Possibly. Could it be a trap? Of course, that's always a possibility as well. But one thing that we do know is that as we look at this market forecast chart right here, this is a 3-month daily candle chart that we're looking at right now using the market forecast tool. Notice that they just had their earnings announcement a couple of days ago. So far, the market has been responding very positively to that announcement. That's a good sign. I'm sure there's a lot of fear that, you know, after all these lower highs and lower lows the stock was making over time, that whatever they said during their earnings conference call was going to spook the market and it was going to continue that trend of lower highs and lower lows. Well, guess what? That didn't happen, at least yet. So far, since the earnings conference call, we've had 2 straight up days to the upside. And not only that, they're fairly significant up days. Notice that today was the smaller of the 2 candles, and today was a 1.25% up move for this stock. Remember, none of the 4 major U.S. indices were up 1% today, so this was a relative outperformer on at least a daily basis and likely a 2-day basis here, because yesterday's candle was also a very strong one to the upside. Well, today also gave us a little bit more indication of its strength because it was able to get up and through that 30-day moving average. Now, that's important because that was not the typical behavior of this company in the past. Notice that back here, it touched that moving average and fell. It responded after a sell-off and tried to get back up there, but notice it kissed that moving average and started that downtrend of lower highs and lower lows. So you might assume that on yesterday's big up day where it closed just a hair below that moving average, that, oh gee, here we go again. This is going to be used as resistance and this thing's going to bounce down. Well, that's why today was a welcome response from the stock, at least if you're bullish. This thing crossed over and sliced through it like a hot knife through butter. This thing is now sitting on the upside of that moving average, which is why you now see that tip of that moving average going yellow. What that says is that we've got kind of a mixed bag here. Before, we had this red moving average, and that tells me that the moving average itself is pointing down and price is below that moving average. When you see it green, like we did up here just briefly, that means that price is above a rising moving average. When you see it yellow, it means that we have kind of a neutral standpoint, because we still have the moving average moving down. There's no denying that, but now we have price above that downward trending moving average, and hopefully if price stays up there long enough, that moving average will start going sideways and eventually start bending higher again. That's of course assuming that interest rates don't go spiking dramatically higher. So part of the decision on your end on whether you take a trade like this depends on what your viewpoint is towards interest rates in the coming months. But for our purposes here, to show just an example practice type of trade, what I thought we would do is sell a put to try to attain this stock at a lower price. And so as we come back over here to the trade tab, notice that I've got this one line item highlighted right here that has a delta of about 25 right now. This one does have open interest of about 1,600, and that's a point that I want to make as well. Remember, most REITs and utilities are not play toys of traders, and therefore you don't find a lot of options participants in them. This is one of the exceptions. Public storage is one of the bigger players within the real estate space out there, so it's good to see that we have lots and lots of liquidity there with 1,600 contracts. And so what we're going to try to do is sell the 185. Now remember, this thing closed at 193 here today. So what we're saying here, for those of you that are somewhat new to options trading, we're saying we're willing to assume somebody else's risk down at 185. In other words, we're willing to be a buyer of 100 shares. And that's another point that I should make. This is an expensive stock. So make sure that if you're willing to be a buyer of it, you actually have the cash available to purchase 100 shares of this stock, which would cost you about $18,000, $18,500 to be exact. But at $185, we're willing to assume risk there. We're willing to buy the stock at 185. Now, typically, what I shoot for from a goal from a credit perspective is getting at least 1% of the strike. You guys are all going to have your own goals and objectives, but for me, 1% is kind of my minimum level threshold that I'm shooting for. So in this case, where we've got a bid of $1.70 and an ask of $2, I'm actually going to put my trade in the middle at $1.85, which is exactly 1% of $185 strike price. You can see that the last trade on this today was at 172. So there's no guarantee I actually get filled on this tomorrow, but I think it's worth throwing out there from a practice trade perspective. Now remember, if you get filled at 185, you can kind of think of it as a way of getting it on sale even further, because $185 is where you're committing yourself to buy that. But if we subtract out $1.85 from that, which is the credit that you're going to receive up front, your true break even on that is $183.15. So if you wanted to see what sort of a dividend yield you would be able to attain if you were put this security, and remember, you're only going to be put this security in all likelihood if it closes below 185 here in March. The third week of March, 22 days, trading days from right now. But let's see what our yield would be effectively if our break-even price was 183.15. So currently its dividend is $2 per share that they pay quarterly. So if we take 2 times 4, that's of course $8 there. We take $8 annualized and then divide that by 183.15, which is our break-even price, and our yield would actually be 4.36%, as opposed to what somebody who would be buying it right now would be getting 4.14%. Because some of you might be thinking of that. Some of you might be saying, okay, I'm willing to jump into this now and attain the 4.14%. So what's the advantage of potentially selling a put as opposed to just buying the stock outright right now? Well, your advantage is that you're taking advantage of time decay, and if you're ultimately put that stock, your starting yield on cost is actually higher than somebody who's going to be buying it here right now. So with that, let's go ahead and click the bid price like that on the paper money platform here. Just going to do one contract. Again, a reminder that this is an expensive stock. And I am going to change this to $1.85 as mentioned before, so that way I can get at least 1% out of this. And I'm just going to leave it in there as a day order. If we get it tomorrow, great. If we don't, I'm fine with that as well. There'll be other opportunities out there. Confirm and send, and we'll ship that out. So thank you so much for joining me here today. We really appreciate your viewership. We can't do this without you. So remember that as David and I start up our business in the coming months, that every effort that you guys can make to like and retweet these videos, the thumbs up, I know it probably sounds like a drag to you, but remember, it takes a couple of hours for us to produce these videos. So hopefully the hours that go into making these videos motivates you to go over to Twitter. Take just 2 seconds. That's all we require of you for this free video to click like and retweet. We'd really, really appreciate that. With that, I'll wish you all the best with your trades and your investments. Of course, David will be with you tomorrow, and I'll be back with you next Tuesday. Go Yotes.